Talking Point. I'm your host, Neeraj Shah. Well, there's lots that's happening in the equity markets these days, though that is always the case, but more so because a lot of global factors are impacting the sentiment in equity markets. The Fed quantitative tightening has been almost undone in a matter of 1 week. The talking points today will be the views of Rajesh Bhatia, and we ask him about the impact of the regional bank crisis in the US on Fed's rate hike trajectory, China vacating its place as the global growth engine and the impact thereof, the impact of the weaker than expected GDP trajectory on equity markets back home in India, and of course, this investment strategy in the current market conditions. Viewers who tuned into the previous interactions would remember that he was cautious when we last spoke to him about 5 months ago. It'll be interesting to see if he's changed his stance now. Rajesh, great having you. Thanks for joining in. Hope all is well.
All is well. Thank you, Neeraj, and it's a pleasure to be here.
Thank you. The pleasure is ours. Rajesh, you were cautious. Are you still cautious, or are you vacating that stance in light of the change in the central banking positions, if you will? Though ECB did not change it at all, but still.
So let's put that in perspective. I think we have been cautious since October 21, and the reason for that is that the valuations did not reflect the risks that were emanating from there on. And the retail enthusiasm, as you would recollect, was extremely excessive. Futures positions, IPO valuation, concept stock valuations, enthusiasm, all of that. Those are really dangerous signs, especially when that coincides with very, very high valuations. If I recollect correctly, the next year, 12-month forward earnings at that time was 20 to 23 times. And a lot of risks were coming ahead of us, which is inflation was galloping thanks to the measures that the central bankers of the world had taken to counter the COVID crisis. They pushed in a lot of money, but the consequence of that was inflation. And that would have meant starting from there on, you had to reverse the primary trend that was driving the markets, which was excess liquidity. So you had to increase interest rates and change the trajectory. Well, it's been 500 basis points or thereabouts of interest rates increases across the globe. It has been roughly 18 odd months since we peaked in the market and have been struggling since. In fact, below the index levels, there's even more damage to valuations. I think 12-month forward earnings are now looking at about 17 or 18 times to me. Also, there is recognition of the challenges of a slowdown, which is abetted by the global slowdown. And therefore, there is acknowledgement in the domestic markets that, hey, look, we are slowing down. Our earnings will need to be revised. And, there is acknowledgement that we were overvalued as a market. So finally, I am seeing the reverse of what you saw in October 21. So my measures of when markets peak are twofold. One is excessive enthusiasm, as I pointed out, and valuation. Today, we are seeing the reverse. There is some sort of disappointment with equity returns. I would have rather invested in fixed income while I'm in equity. Valuations have corrected. Acknowledgement of the fact that there is a slowdown. So I think it is too late to be pessimistic. That's really what I would like to, how I would like to put it. It's too late to be pessimistic. My sense is this acknowledgement and coinciding with what's going on in the globe, it could possibly lead to some more correction in the equity markets. But I think that is a time to start now nibbling into the markets. So from my earlier position of being that the risk return is not attractive, I think we are coming to a stage where we are getting excited because other people are fairly depressed in terms of how they view the equity markets from here on.
So you are not lock stock buying, but you are chipping away at select names.
I would say that's fair to say, and I would say that we are looking. Now we are looking we know that the time to get greedy is coming. See, there's a time in the markets to protect downside, and there's a time to make money. From October 21, we thought it was time to just protect money, and I think now the time to make money is coming.
Okay. Would it be event specific? Would it be level specific? What would be so Rajesh, as I understand, I'm just trying to get this clarity that we are probably in the zone where it is time to make money. You are starting to look. What will make you believe that, hey, let me now go and put large gunpowder to work?
Well, I think in a slowing economy, global and local, a high interest rates environment, there is really absence of positive narratives. You're more looking at weakening of earnings, etc. So therefore, you require a margin of safety as far as valuations are concerned. So what we are looking for is, at this moment, of course, we are fairly stock specific. I don't think there are as many sector narratives going around. Most sectors are actually looking from a negative narrative to as to say. But one, I'm looking for price correction in these negative narratives as well. And on a stock specific basis, that if they come to my attractive valuation, we have targeted prices for each of these narratives, even if the narrative is weak, but the valuations are attractive, that's the time for us to kind of go and buy those stocks.
Okay. Let me try and tackle this in a few ways. And then, of course, we can end with the macro again. But since we've dwelled into the micro, let me try and attack this in a few ways. Before the last RBI policy, the belief was that the RBI will go on a pause, will start to sound to the market's mind a bit dovish, even if they're not outrightly dovish. And that would mean that you change the tracks on financials, for example, long NBFCs, maybe not short banks, then not as long banks, start to go long on other rate sensitives like real estate, which have been clobbered in the last 6 months, even though the sales numbers have looked okay. And some of the other rate sensitives. My question is, that may have not happened, but if the global central banks do go a bit soft on their inflation hawkishness, and we know that the RBI doesn't have the support of the strong labor data that the US has, do you think the market would start to play that theme again, which is long NBFCs, long real estate, long some other rate sensitives?
Eventually, yes. So what is, perversely, what is happening with the small regional banks in the US could actually be addressing a significant problem of the markets. So that's perversely because, it is, to some extent, it's a bit like an ILFS episode in America, right? If you had a 500 basis point increase in interest rates, accidents are bound to follow, right? Some people are bound to have, emerge from or have fault lines, right? So as to say. So, what happened in the ILFS crisis was ILFS blew up, then probably DHFL blew up, and then Yes Bank blew up, in that order. So there will be some challenges, and it may, SVB may not be the only one. We may find out that there are others, and that's what the apprehension is of the markets as well as the central bankers. That there could be others as well, which could lead to some kind of risk aversion, which could lead to tightening of financial conditions, which means economy slows down, which means the number one problem that the central bankers and the equity markets have been grappling with, which is inflation, and therefore interest rate hike, could suddenly be looking to reverse. But this happens in the stage 2. In the stage 1, risk aversion happens. There is a global slowdown. US enters a recession, and therefore it may be premature to say that you should buy cyclicals right away. I think there's going to be some kind of downside pain that comes in before you go to the phase 2. There may be some kind of a premature rally, but my sense is that eventually they'll realize a lot of things are not in place. So it may take some time, but it definitely perversely addresses the number one problem that the markets have been facing, which is, sticky inflation. And therefore, perversely, India could actually benefit eventually from what is going on.
So are you saying, Rajesh, that what could happen is that if this bounce that we're seeing today, for example, extends itself, then it's not a trend change, but a bounce which will get sold into, and the markets will reset at a lower level before the trend changes?
So I think this situation is still evolving. Now, look, ECB increased interest rates by 50 basis points. They didn't want to move away from that trajectory. And my sense is the reason for that is they also don't know how it is evolving. So they don't want to prematurely talk about that there is a problem. So unlike 2008, where there was an asset bubble which crashed and where suddenly you found all the large banks were also involved in that participation of that asset class, there was a greater sector-wide or economy-wide repercussions of that. This may be more specific to certain institutions, right? So that is really what I would say. So I don't know if this is going to be all-pervasive challenge. So we'll have to see how that evolves. Does it lead to greater challenges? What comes next? What happens to Credit Suisse? So this is a slightly evolving kind of a situation. I'm sure that Fed next week will also not blink and pause or anything of that sort, or maybe they kind of say that, look, we are still evaluating the situation. That's what the ECB did as well. They have said that, well, we have raised by 50 basis points, I can't tell you what my next move will be, which means that they're also keeping cards close to their chest because they're also seeing how this situation will evolve. So my sense is you should allow that situation to evolve to see the degree of challenges that emerge from there. But my sense is it's going to be a fairly limited kind of risk aversion. It's not going to be 2008 all over again.
Rajesh, just one quick macro question before we dwell a little bit on the other things. If the Fed chooses to not sound as the ECB did, if you will, and they say that they're evaluating, but it's not a 50, it's a 25, and they sound to the market's perception a lot more dovish, do you think that sets the stage for a slightly larger up move, or is the market already discounting that because bonds have rallied? I mean, the Fed peak has gone down from 5.5 to 4.85 already.
See, bonds are extremely volatile at this stage. I mean, I don't think the market itself is able to make out. I mean, they did crash before they've kind of gone back up. So I think it's too premature at this moment to make conclusions as to the next direction. There is a lot of volatility. I think there's still things are emerging. From my perspective, I don't think I'm going aggressive at this moment. I'm actually looking at what if this results in a downside, right? And then we go in specific stocks. So this is not the time for us to go aggressive on equities, but this is the time for us to evaluate what if it results in a decline. Then I think, look, we always keep talking about the India narrative, $3.5 trillion economy, $7 trillion. Now we have to always remember that when these downsides takes place, that narrative is going to come back at some point of time. So my sense is that from my perspective, actually, rather than react to these immediate news flow, we're going to look at whether this does result in a greater risk aversion for us to kind of buy stocks.
Okay. Now, when I look at, so with that having been established, let me try and ask you in a different fashion. When I look at the ecosystem as it stands right now, there are exporters who are exposed to global slowdown issues. There are local champions which have not corrected because of order inflows or otherwise, so defense, railways, maybe industrials doing really well. And then there are local champions who have corrected, maybe because of rates or otherwise, real estate, for example, right? Or even local chemical companies, which are not exactly global in nature, but have corrected because of whatever reason. And cement hasn't really set the stage on fire despite the promise of infra spends. So where is it? I know you're stock specific, but I'm still trying to understand within what themes do some of those things fit in at ITIMM?
So, let me reiterate again. I think we want to be stock specific. So let's say in the consumer sector, staples, there's a lot of weakness across, but there is a staple companies that is growing, quite handsomely, right? Which was undervalued at some point of time, and it's gaining traction. So that's what I mean by stock specific stuff. There is an NBFC which is kind of changing course because it was earlier saddled with a lot of high cost borrowing, and that kind of is ameliorating at this moment, and which could kind of help. So we are actually going a lot more stock specific. into each sector. So it's not really as if there's a sector call, but it's really that the individual companies' metrics make it more attractive. Having said that, from a sector level, first let me tell you what I would avoid. At this moment, I would avoid global cyclicals. At this moment, I would avoid high PE stocks witnessing increased competition like paints or diagnostics. I would avoid borrowers who are extremely dependent on wholesale market, right? So those, I think, are the ones to kind of watch out for. Even sharply cyclical domestic, although real estate is doing quite well, as you point out, the pre-sales numbers are really very, very strong. But we don't know whether there's a lagging lead indicator or lagging indicator that will follow, which will show weakness later on. And that's also a sharply cyclical business. But at this moment, real estate is extremely strong. So what would I buy? Now, I have eyes on, apart from that stock-specific approach, I have eyes on, let us say, IT. I don't think IT is that, even though we are the markets are pricing in a slowdown or a recession in America, IT stocks have corrected quite a lot. Their top lines are not as sharply cyclical. I don't think I remember in 20 years their sales being down, even in 2008, 2009. So there's a lot of annuity to what they're doing. The long-term thesis to Indian IT is extremely attractive. There's a lot of digitization that's going to take place in enterprises over the next 5 or 10 years. And there is no other country to supply that except India. Secondly, I think their cost metrics are also in sync with their top line, which is the manpower cost inflation will erode as there's a fear of a slowdown. So my sense is the cost also kind of adjusts to the slower top line growth. Plus, what we are hearing from companies is now they're starting to get price increases as well, because there is recognition even in America of the problem of inflation. So there is a price increase that is taking place. Of course, they are adjusting to lower growth rates. But my sense is when I look at forecasts of analysts, a lot of that top line adjustment has already taken place. Maybe it takes place for another few percentage points, but my sense is on that basis, valuations are turning a little attractive. And I'm referring to really the larger companies. And so if they do correct even more, my sense is that's another area that we want to look at.
That's interesting. The IT is in the thick of things, notwithstanding what's happened with TCS, Rajesh, and your namesake has put in his papers. But that notwithstanding, the notes by and large are now talking about how the valuation comfort in some large caps or valuation comfort in mid caps. Those are the stocks. And people are not talking about heavy buyers in persistence, etc. But they are talking about being buyers in the science and some of the others of the world, which are ER&D as well. So while KPIT is gaining those orders, people are preferring a sign which is much lower value. So my question to you is therefore, within IT, are you kind of setting that same thing wherein you are first looking for valuation comfort and then looking at growth prospects?
So, so it's a good point, but I don't think valuations alone does it. So there have been historical records of companies with lower valuations, some, but have not done as well as companies with higher price earnings. So price earnings, is not the only metric. The other things matter as well. Some of the newer companies, if they are focused on enterprises, the newer companies came with digital models. So they didn't have legacy challenges. So their growth rates are also far more attractive. So of course, they're bound to quote at higher price earnings. And so the other engineering companies that you refer to, again, their visibility of growth seems to be extremely strong. And the market share that India has taken in that category, again, is extremely low. So their prospects of growth rates are extremely high. And even today, despite the challenges that we are seeing, the commentary from them is quite encouraging. So I wouldn't say, if the question is, would low PE be the way to go? I think the answer is not. It just depends on the quality of growth and the rate of growth, etc. Those are equally important as you move forward.
Rajesh, you look at cycles very closely. I would love to understand from you what your view is on comments that I hear about industry. So when I question people who are constructive on the industrials, and I mean, just for illustration for the viewers, what I mean is the likes of the ABBs, Siemens, etc. of the world. Rajesh, I'm told that the starting point is looking expensive to you because you're looking at depressed earnings valuations. If you extrapolate 3 years out to what these companies typically do in an upcycle, which we believe they are in, then the earnings will suddenly, or the multiples will suddenly look very attractive. I would love to understand how you are thinking about this pocket.
I think as you have moved into this environment, I must point out one thing as a fund manager. Earlier I would have vouched for concentrated portfolios. I think now I'm more inclined to have a more diversified portfolio, because suddenly I'm seeing that I'm not able to anticipate where accidents come from. I'll give you an instance. I mean, in the budget, there was changes in regulations for taxation for life insurance companies, right? And that kind of took the wind out of life insurance companies. There are changes in regulations that are taking place for asset management companies, right? So again, there is some kind of outlook change for those. There is possibility that health insurance companies will be life insurance companies will be allowed in health insurance. What does that do to general insurance companies? There are just so many factors like that. Competitive intensity in paints. You would have thought paints is a mode business, etc. And there are so many mode businesses which are changing their narratives, right? I mean, we've experienced that in the last 18 months or so. So my sense is that it's far better to have a diversified portfolio, number one. Second, in terms of investment philosophy, I believe that the best returns are made when you not only do well on EPS, but also P. So when your starting point is 60p or 70p, first, there is really no margin of safety on mistakes. Second, at best, you can hope to earn EPS growth, right? So we believe that our investment philosophy should be, make sure that the starting point is attractive. I can tell you I have exposure to some of the best investors in the country, which are as good as any global investors, Nimesh Shah or Radhakishan Damani. And I can tell you, although I've seen them from far, but the first question they ask is, how much am I paying for this, right? And somewhere in the Indian institutional fund management industry, that principle is diluted to some extent. And I have a theory why that has happened. It is because, see, look, for the last 15, 20 years, the central bankers of the world repressed cost of capital. Real rates of interest were low or negative, sharply negative, because they always feared deflation, right? And that led to companies with high free cash flow trading at higher and higher price earnings. Somewhere it got embedded that high PE strategy is the way to go. Don't worry about, I think, price earnings. You just concentrate on consistency of the company. Even that consistency is coming into kind of doubt for a lot of companies. I think that entire era has changed because now central bankers of the world are no longer worried about deflation. They're actually worried about persistency of inflation, as you move forward. So real rates have turned positive. So my sense is that these high price earnings companies, which seemingly are consistent in their forecasts, are most challenged as you move forward. So that's the second point I would like to make, that in my framework, that is really how it is evolving. So I hope I've answered your question. For us to approach these 70p, 80p companies, in spite of their attractive prospects, are not something that is very alluring to us.
Got it. My final question, Rajesh, on this conversation, and there's a lot of investing wisdom today, but my final conversation is on something more actionable, if you will, and that is on the recent spate of the Atmanirbhar policy. Much as people would want to dismiss some of the moves that happened in 2022 as one-offs, various announcements keep on coming time and again, which show that this government seems to be very serious about that, be it railways or be it the more accepted defense. I mean, defense is a large bucket, even if railways isn't. But a lot of firms are now getting consistent order flows. Now, they got sold off after the mammoth rally in 2022, thinking that, hey, this is a flash in the pan, and we've seen various times these promises which haven't lived up. Is this time different?
So if your question is defense a very attractive space, I would say yes. But you just have to keep in mind that they have long gestation periods and a lot of their order books come in kind of patches. But is this a theme that I would back over the next 5 or 10 years? The answer to that is yes.
Okay. Great. Rajesh, this was lovely. And I can only see from the note that I read as well that you believe that, and in an answer you mentioned that at some point of time, this India narrative of $3.5 trillion economy growing, taking China's place in a place that China is vacating, will come back and really do, but maybe that is at a lower valuation. I hope I got that summation correct.
Absolutely.
Great.
Valuations matter.
Thank you, Rajesh. I really appreciate your time, and viewers, thanks for tuning into this edition of The Talking Point.